Okay, welcome to Unit 3.1, Cash and Internal Controls. As you can see, this unit reverts back to something we discussed in Module 1, and that is the discussion of regulations and compliance and who mandates these protocols, especially when we're dealing with cash. As stated, cash is generated from various sources. What kinds of sources? Products that the business sells, land sales, and some types of investments. Since cash is an asset acquired and generated from business activity, internal controls must be attributed and created. As mentioned previously, this is for compliance purposes, which are indeed regulated. Who regulates them? Well, first and foremost, GAAP. Generally accepted accounting principles. Who monitors GAAP? Well, remember, somebody's always watching. In this case, the Financial Accounting Standards Board, the FASB. Also, the AICPA, the American Institute of Certified Public Accountants, has a big play in this. So just keep in mind, once you hear the word internal controls, that means somebody else is watching. Nonetheless, this implementation allows for an increase in profit. Internal controls, as discussed, increase profit. Whether it's cash or other types of currency, profit is key, and let's always know the key is to have the assets going up. There are other reasons to possess internal controls besides safeguarding assets such as cash. For instance, accurate financial statements. Check this out. There's cheaters everywhere, especially in business. Cheaters like to cover their tracks by falsifying financial records. Now, that's not only unethical, it's illegal, but you hear about it a lot, and it's been going on for centuries. This causes owners to make bad business decisions, whether it's the owner actually doing it, causing his own demise, or if it's one of his employees messing up the books, improper bookkeeping, and literally falsifying financial records. Not only unethical, carries heavy jail time. Okay, adherence to policies. Every company must adhere to their own policies. For instance, we're not just talking about a code of ethics. We're talking about government-regulated policy and administrative internal regulated policy that the companies, for instance, if you get hired, you're a new employee, here's your manual, read the manual. That's what we're talking about. So, adherence to policies stands for good controls. And it's in writing. And the way business is really attributed today, if you don't know the policies, shame on you. So it's good controls which make people more likely to do what owners want them to do. People don't want to violate policy because they know the repercussions. With that said, legal protection. Certain laws make owners responsible for the crimes of employees if weak internal controls are allowed if the crimes to happen. Now, the owner or investors, i.e. the bigwigs up top, they don't always know that crimes are occurring. However, they can still be responsible for it in the workplace, and that's a problem. So let's remember, the owner is also responsible. Now, he may not get in trouble on an individual level for violating a law, but as a business entity, he's in trouble. And here we go with two more. Separate accounting from operations. As discussed previously, we have business operations. Business operations are highly attributable to all financial activity of what's going on under the owner's eye. So, separate accounting from operations. A person who keeps the books for a business and authorizes payments can steal without getting caught. Well, in the end, they always get caught. But I will assure you, the key is to monitor and have audits for even the bookkeepers. Because you have business operations and then somebody else who may be conducting improprieties where there's weak internal controls or knows the internal controls, they may try to get over. And here we go with separate accounting from custody of assets. Now, assets are our biggest prize, if you will, internally with a business, okay? So a person can take assets as well as remove them or any record of them from the books while stealing without getting caught. That's another thing. Business operations and custody of assets are paramount, so we have to separate the accounting from that. What we're talking about when we say separating accounting, we mean oversight. As I discussed in the beginning of the course, accounting is a concept with a lot of oversight. Anytime you use a lot of numbers with a lot of money and business entities and all these laws coming down on operations, you have to have separation. Okay? It's almost like separation of powers. This is 3.1.